So I think that in a few years, 3, 4, 5 years, you're going to see that the Canadian market is going to be able to run more efficiently, accurately, transparent compared to the US because of the adoption of the new technology that's coming online with respect to getting access to customer information to make credit decisions.
Hi, everyone. I'm Ashoka Maimona. I'm here as your host today on behalf of Smarter Loans. And our guest today is Jordan Fein, the CEO of Greenbox Capital, an alternative lending company that offers various types of business financing. Hi, Jordan.
Hi, Ashoka. How you doing?
Good. How are you?
Doing well. In the house still. We're actually starting to get back in the office a little bit more, but we're still here, but everything's going well. We're ramping back up. And I see that Canada's doing the same.
We're trying. Ontario just went into their third lockdown. I don't think that's the case in Miami.
No, not at all.
Yeah.
We're seeing much more demand. I hear you. We definitely know about some areas of lockdown in Ontario. We're seeing much more demand for the products. We're seeing revenue start to increase in various different industries in Canada as well. If you rewind, let's say 2 months ago, you were seeing way less submissions from the Canadian market. Way less submissions. I'm starting to see a little bit more now.
That's amazing. Really, I think we need to hear stories of such optimism. So before we talk about clients, let's talk about you. Let's talk about your journey, your professional journey, how it led you into business financing and how you created Greenbox Capital.
This journey started in 2007. I was in credit card processing. This whole space that's all over the world came from the credit card processing space, originally from one company called AdvanceMe in 1999. It was in the United States, and they had a patent on basically providing merchant cash advance through credit card receivables. Small business loans, the way you know it today, didn't exist. It was morphed into that, and I'll get to that in a minute. But essentially, there was one company, and we were referring out these clients of ours to get capital for their business. And one day we said, "Hey, these commissions are great, but why don't we do this ourselves?" Right? So we started to do that, and I focused exclusively on that, and I wanted to build. Literally started the company with a desk and a phone, and wanted to build underwriting standards, data tracking, policies, procedures, risk management tools, controls, everything that you would think that you need for a finance company. We weren't a fintech yet, but we were more of just finance, just making loans or making merchant cash advance and deals. Loans weren't even out there yet. So we did that for a few years and built up our portfolio. And before we knew it, we said, "Hey, look, let's try to get other deals from other credit card processing companies." So to do that, we said, wait a second, what credit card processing company is going to give us their business as a credit card processing company? They're going to think we're stealing their deals. So that was right around 2012 when we created Greenbox Capital, an independent company unrelated to the credit card processing company. And there it was. Greenbox Capital was focusing exclusively on merchant cash advance. It was only in the US market at that point. Didn't offer invoice factoring, collateral loans by real estate like we do today, just merchant cash advance. And we started basically getting different credit card processing companies. And at this point, brokers started to come into play. The brokers were the credit card processing companies, but then full-on brokers were out there and just doing a better job than the credit card processing companies. They were just not what they were supposed to be doing because they're focused on credit card processing. So then credit card processing companies became obsolete. And at this point, somewhere in the same neighborhood of plus or minus a couple of years, well, let's go back a second. 2008, the patent for merchant cash advance gets blown by a group of companies, and now there's several companies that are offering merchant cash advance. And then in comes the ACH debit, the merchant cash advance ACH debit, and that developed into small business loans as we know it today, where you have your large PayPal acquiring Swift, and you have your Square who's doing loans, even though it's out of credit card receivables all over again. But that's how the industry really developed. They said, "Hey, look, we're running out of companies to fund with credit card. Let's just fund companies that don't have credit cards too." So there you go. And then it really became a lot easier to fund businesses through ACH than taking out the credit cards. We talk about delays in getting your revenue if you're on a lockbox, or if you needed to be integrated, it just took too much time. It's just so much more seamless. So now you have the industry of the small business lending and the small business alternative finance MCA industry as we know it today, which is fast, seamless, ACH debits, or in Canada, an EFT to your bank account, very, very seamless. So that's the journey of how I became into where we are today. And then we joined the Canadian market in 2016. And I'll tell you, we were very happy we did. We love doing business in Canada. It has really, for diversification purposes, but also I tell this to everybody. I think that the Canadians have great financial responsibility overall. Especially compared to the United States. They just perform better. I think they have a little more integrity in their financial responsibility behavior.
Mm-hmm. No, that's an interesting point. And I was curious to ask you about that because you mentioned 2016 is when you entered the Canadian market. And that's sort of the year 2016, 2017, when the alternative lending space, I think in Canada really started to take off with, major players like yourself entering the market. So what was it about the Canadian market that brought you north?
If I could give you a little bit about myself, it'll help you. I am a person that's innovative. I'm a person that's curious. I'm a person that likes diversification. So being that we're in the US market and seeing that Canada was kind of untapped in terms of it was new, made me curious to look into it. And I said, look, they're right there. We operate the same hours. Let's do that. And I thought the American market really starting to heat up and really start to get over leveraged. And I just we're not the kind of company that's ever gonna, and there's so many companies out there that are like this. We're not the kind of company that are going to just grow at all costs. We're not going to just change our underwriting standards, fund deals. I don't believe in that. And that's why we're here post pandemic. I think that you have to prepare for downside. I think that's super, super important when you're managing a portfolio of assets. And the reason why was really diversification and curiosity of okay, let's go into this market. Let's see what opportunity is there. And I'll tell you, on one hand, the availability of data is very different than the United States, right? The laws.
Mm-hmm.
And it makes it much more difficult to underwrite. It really does. You get access to less information. So you could get into trouble as a funder, right? You really could. I think that there are certain things, there's certain do's and don'ts that we learned over the years of how you have to approach it differently. And if you don't, you can end up having way worse performance in the Canadian market than the United States. But we have found success in the Canadian market. And I'll tell you, it's been a good match. And we're excited to continue to grow that footprint as well.
Mm-hmm. No, it's interesting. Yeah, the privacy laws definitely, I think, would limit the type of information you have access to. But in terms of what you've encountered, I know in Canada we love to do comparison narratives, especially with our neighbors down south. I mean, you can talk about clients, but also the larger landscape itself. So the alternative funding scene here versus the US. Perhaps you can talk a little bit about tech as well and how fintech fits into that. But where are we in Canada in relation to what is a very heated alternative lending scene in the US?
There's less lenders in the Canadian market, and there's way more lenders and funders in the US market. How does that change things? I don't know if that changes things too much. I really do think that the behavior lies, what the stacking, all that stuff ultimately lies with the behavior of the customer or whether the broker can convince them. There's some brokers that will convince them to take more money, which is absolutely evil because that's not necessarily good for the business. It increases defaults. But then there's some merchants who will be reckless, right? And in the United States, and you don't see that as much. That is a big, big difference. And I talked about it earlier. And in terms of, you talk about the difference of the markets, brokers in the United States demand these very large commissions, and it just wasn't developed and doesn't exist that way in the Canadian market. We do offer larger commissions, but there's other companies in the Canadian market that do direct. They do direct as a big part of their business. They do brokers as well. They don't pay large commissions. They pay much smaller commissions. And I think that this is a very touchy subject because brokers obviously want the largest commissions, but there's a certain point we have to cut that off, and it's not good for anybody. It's just too much. The economics of the deal becomes too negative for the business and it ends up hurting everyone. Why does it hurt everyone? Well, yeah, sure, the broker makes a big commission to start, but the lifetime value of that customer is now shorter because if their propensity default is higher, then the possibility of renewing that customer and a portfolio of customers goes down. So I do think that the Canadian market is better well built in terms of how it's structured with respect to commissions to brokers. And I think that's a nice advantage the Canadian market has. And I hope that never changes because it's good for everyone. It's good for the business. It's good for the broker, whether they believe it or not. And it's definitely good for the funder. the funder always wants what's in the best interest of the business. You always want your businesses to survive and do well. If they're doing well, you're doing well. We're not taking an equity stake in the company, but it's pretty darn close. You know what I mean? Making a debt position in these size companies is very darn close to making an equity position and really betting on the company to do well. So that is on the broker side. And then let's talk a little bit about fintech side. It's a much smaller country compared to the US, of course, right? But I'm so surprised by the different innovation and technology that does exist. The startup that I have is a software product that is going to help the lending industry, right? It's going to help facilitate the funding process and take away a lot of inefficiencies, bring a lot of clarity, reduce operating expenses of lenders, increase efficiency of what the brokers have to deal with when dealing with customers. And the borrower or the merchant is going to have a more seamless experience, not have to fill out all of these forms and get all these bank statements. It's a product that's going to bring efficiency, transparency to the industry. And I'll tell you, the companies that I've seen that are also involved in the fintech space up there have been super, super impressive. Super impressive. So I think that the Canadian market, while smaller, still proportionally has amazing innovation happening in the fintech space for the different products. There's so many different products that are up there. I mean, there's risk management tools that are up there in the Canadian space that we've looked at. There's data aggregation tools that we've looked at in the fintech space. And there's much more. I mean, there's so much more. You know what I mean? I think that the Canadian market is right there. They're also developing their APIs the banks are developing their APIs. And I will say this, here's one last thing on this. I actually believe the advantage in the Canadian market compared to the US is with the banks. In the US, there's 21,000 banks, and the top 10 banks control 68% of the market. The top 4 or 5 banks, I forgot what the stat is, controls like 95% of the market. So their ability to increase their technology to be able to better serve business in Canada, consumer and business, through technology is going to be a lot easier because adaptation with banks and different players like that, because they hold the data of what the fintechs and the funding companies need, and they're building out those APIs. So I think that in a few years, 3, 4, 5 years, you're going to see that the Canadian market is going to be able to run more efficiently, accurately, transparent compared to the US because of the adoption of the new technology that's coming online with respect to getting access to customer information to make credit decisions.
Mm-hmm. No, that's you've given me a lot of food for thought. But let's pick on something that you ended with. So you mentioned the big banks, and I think the Canadian reliance, perhaps some would say over reliance on big financial institution like big banks. And then you also mentioned earlier PayPal and Square entering the alternative financing market. I mean, where does that situate the current players in the business financing industry, specifically in the alternative lending space? Because now you're having these big players like PayPal and Square entering that have captive customers that have access to large troves of customer data. I mean, is that cause for concern? Is it an area for innovation? What are your thoughts?
As this industry matures, it's going to be even more difficult to enter, just like any emerging industry. As the industry develops, the inefficiencies are taken out, the players achieve scale, and it's difficult because what's happening right now is you're seeing a major shift in technology. 3, 4 years ago, to get a decision on a submission was maybe 3, 4, 5 hours. I don't know, depending on what kind of shop it was. Now it's down to under an hour. And what do you think it's going to be in 2 or 3 years? So I think that it's super important to recognize that if you don't have technology in your business, to achieve scale will be just about impossible. And I think at this point, it is impossible. It already is impossible, right? But if you're doing things without using technology to make decisions, you can make a couple shekels, at a small level, but I think that you'll be outplayed by the competition because of speed. Speed drives our industry. We all know that. Everybody is competing. I can get you this offer. I can get you this offer. And a lot of times, speed wins the deal. This offer may come in, it's better, and it's just 20 or 30 minutes behind, but the other one already has contracts out. And that's because the customer got the offer that they needed. They're like, I want the 50, and they're ready to go. But this was 50 at a slightly cheaper cost. Well, you know what? You were slow. You lost it. So going back to what you were saying, companies like Square, PayPal, the larger companies with technology are going to have an edge up simply because of that. The other area where Square and PayPal have a great edge is in customer acquisition. If they have these large databases of customers that they're constantly marketing, their cost to acquire is lower. So they're able to give a much lower cost and they already have information on these people because they're doing business with them. So now maybe their bad debt expense is lower on these customers. And these are the drivers of the business. You got your bad debt expense, your customer acquisition, your operating expense, and your cost of capital. That's it. I mean, those are the main drivers. And if you're able to reduce that, then you could be extremely competitive. And plus, it's a branding thing that as well that they get as well. So I think that it is of a concern. I don't know if I'm concerned for Greenbox Capital. I'm not going to say I'm zero concerned. There's definitely a level of concern, but we're doing our thing. We have a strategy, right? We've been in this space for a while. But if I was telling that to somebody of newer players, I think they need to figure out how to get technology in. If they want to come into the industry right now, they have to figure out how to right out the gate, get some kind of technology. Without the data and able to make those decisions, they're just going to have to do trial and error and learn about either what they know or what their intuition tells them. But data is king. The more data you have, the better decisioning you'll have on the pricing and credit side. I think that there is a concern in general that everyone has to be somewhat concerned about these large behemoths of businesses. Remember, these companies, they don't need their capital arm, okay? They make billions of dollars. The capital arm is probably a break even for them. When Square's putting out 9, 10, 11% interest and PayPal's doing the same, they're barely making money. They're doing this to create their ecosystem around their clients and say, look, we can offer you capital. We can do this. We can do that. No need to ever go over to Square. You got PayPal. They're playing a different game. So for us, that are a lot of companies in this industry that are just offering capital, we need to make money for our existing products. So yeah, that would be a concern in of itself. Ecosystem is huge right now. It doesn't matter where you are, what industry you're in, ecosystem is a big deal because it revolves around software, making things easy and seamless.
Yeah, definitely. I don't know if there's any trends or innovations you've noticed in the lending space this past year. Of course, with I think the stressors of COVID-19, it's probably either hindered or propelled momentum in some of these areas. Like what have you seen on the ground?
I can talk about some trends that I'm seeing when it comes to business owners, customers, and what they're in. Right now, the big trend right now is they love the line of credit. They love when they can get capital when they need it. Let's say, for example, they're approved for 100,000. They don't have to wait until they're 50% paid in. They could take 10,000 now, 10,000 tomorrow, and we offer all this. And they can take it as they need it. And then the other component is the early payoff discount. And a lot of companies are offering this now, and it's very important to customers. I was trying to think why, right? Maybe it's just chance. Maybe it's because they got so excited about the PPP money in the United States or the government money program in Canada to be able to support businesses, and it's super cheap. It's almost all free, but we had a program here too that you do have to pay back and it's super cheap interest. It seems like maybe they're more cost conscious, right? I'm not sure if that's exactly it, but those are the biggest trends right now is, hey, can I use this as a line of credit? And if so, can I pay it off early and receive a discount? And, that's very big. Other trends I've not seen other than speed, which I spoke about, it's just getting faster. And more seamless, less steps. I think, as companies have gotten more data and able to better underwrite, you do require less steps because you know the deals that you want, you know what to look for. Other than that, and I'm seeing that increase. Like over the last year and a half, it's incredible the speeds that we've seen increase. The requirement for speed of other companies, it's just gotten faster. That's it. Those are the big trends that I have seen. There's been some trends from COVID in terms of the type of businesses that are doing well versus not doing well that people are competing for, and you're seeing much more restrictive pricing on. But I think those are the ones that you expect, and that's more short term.
Mm-hmm. Okay. And in terms of fintech, I mean, obviously innovation's happening, on a daily, weekly, monthly basis, oftentimes at warp speed. But in terms of how much room there is left to really enhance and improve the borrowing experience, what can you say about that?
Oh, there's a lot that can be done. I think that there's still a long way to go to improve the borrower experience. And their data and protecting their data is, to me, one of the most important things that should be done, will be done, and can be done to be able to improve the experience. The way the process works right now is they're being called by brokers all day long, or they go on a website, they fill out, and they get a million phone calls, and that is daunting. Okay, that I feel bad for them. They literally go out and fill out a form, and their phone is literally ringing off the hook. And I don't think if they knew that, they would have signed up for that. But essentially, they have to go fill out an application, right? A credit application. If they go get their bank statements, right, and they submit it. And the thing is that the brokers are generally unlicensed, it's just unregulated. And what usually happens, not always, but often, brokers are submitting to brokers who are submitting to brokers, and you just don't never know how many brokers it takes to get to a funder. Sometimes it's direct, a lot of times it's direct actually. but their data is being passed through email in an unsecured fashion, and their information is all over. It's not tracked. It doesn't know. It's inefficient. It's unsafe, and it's how fraud happens. So I think that the industry could really grow up there in that area, and I also think that the industry should just be more digitized, right? I think that would be something that could really help, and that's kind of what I was talking about with the banks and APIs, things like that. And I think it will happen. I think it's going to come, and it's going to help the borrower make more sense of what's going on. They don't know. They come to the transaction and they just don't know. And I think that it would be nice to give them that transparency. Funders do, right? They do. They a lot of times they're explaining. We do that. We explain everything that's happening. But I'm talking about at the beginning of the process, understanding what's actually happening with their data, what's going on, and I think that'd be really nice. The other part is there's a lot of good brokers and there's also a lot of not so good brokers. And the reason why I say that is because it's mostly unregulated and they say things that you have to sometimes clean up and you have to make sure that they understand what's going on. I would love to solve for that problem. I would love to have some type of standard or requirement that brokers have to abide by or they get blackballed from the industry, some kind of licensing for brokers. I would love that. Nothing would make me happier. Oh, actually, I would say nothing made me happier. There's a few things that make me equally as happy. But I think that, again, with the borrower, it's not fair. It paints a bad picture on our industry. I would love to clean that up. Where it's an even playing field. Brokers have to operate from an even playing field. So they have to have either great relationships, good process, build a good rapport, as opposed to say things that maybe bend the truth, break the truth, whatever. It does exist. That's just what it is. It does exist. And I think, look, my best recommendation to any borrower, tuning in would be to Google and check reviews of the funding company and the brokerage, both of them, and really, really check them, right? And when you get an offer, check to see if it's from that brokerage or a funder, and then check the funding company's reviews as well, because they're often different. And then reconfirm what you were told with the funder. That is a great way to make sure that you're protecting yourself. So if you apply and it's like so-and-so brokerage and they say they're a direct funder, which they all do, and they give you an offer and you review them and you're like, okay, the reviews are good. I'll go through with that. And then you get a contract and then the contract says Greenbox Capital, for example. Google Greenbox Capital reviews, see what they're saying, and then talk to them and ask them questions saying, here's what my broker told me. Here's what's going on. Is this what's happening? Is this what's happening? Be in communication. That sets you up for success to make sure. And we're also doing our part too to make sure that we say, here are the terms and conditions. You agree to this, you agree to this, you agree to this, because we want to make sure that it's done in fair dealings, right? That we do. That would be some of the best advice that I can give to give transparency right now in the industry, which how it exists.
Mm-hmm. Now that's really helpful, Jordan, because most of our viewers are borrowers, are SMBs. So in terms of your list, if you were making a list for a customer, for a borrower, what he or she has to, sort of sort through, go through when they're looking for capital, what should they keep in mind? You already gave us some very helpful, tangible tips. Beyond that, anything else they should be mindful of?
Oh, absolutely. I think setting expectations is king. And then that is number one, if you're a business, right, and there's not collateral in the sense of homes, boats, money market account, right, which is what typical collateral looks like, you have to recognize you're getting capital against your revenue, right? And the revenue of the future is unpredictable. So understand that when you associate bank rates and bank interest rates at 3, 4, 5% for your home, you're not going to get that against receivables. It's much more uncertain. And I think that if you're growing a business, right, if you're growing a business, you need to say to yourself, okay, I'm getting capital for what purpose? If it is to increase your revenue and grow your business, yes, the cost matters, but the market sets the cost, right? The market creates it and sets the cost. If somebody's out there and says, I'll give it to you for 1%, the market says 1%. If 5 funders come out there and say, I'll give it to you at 20%, the market is 20%. Be open-minded to what the market is and collect many offers. I've seen so many times where borrowers will literally say, oh my God, it's not 8% or 6% or 7%. Maybe they're a 1-year business, which is high risk. They don't realize that. And they're like, I'm out. Well, look, making that decision based on that and not listening to what the market says is short-sighted if you're not considering what you're using the money for and how it's going to help your business. That is huge to understand. And that's the advice for people that what we call rate shock, because they don't really understand that they're not the same thing as giving their home at 2, 3%. It's just not, people just don't know. It's new to them. They associate banks and loans with 3, 4, 5% interest because that's what they got with their home, or that's what they heard, or that's what they think it is. But this is a newer space. This is against smaller business, which is unpredictable revenue, right? So that's number one. Number two, you need to prepare your business for it. You need to make sure that when you're going to submit yourself, you want to make sure your bank statements are what we call as clean as possible. You're paying your bills on time, and sometimes you're not. And sometimes that's maybe why you need capital. And there's products out there to help that. But keep in mind that you're being assessed based upon many things, one of which main component is how clean your bank statements are. Are your revenues coming in consistently? How are your average bank balances? Are your average bank balances consistent? Are you maintaining a decent average bank balance? What is a decent average bank balance? At least 5%. Ideally, you want to see 10%. And what does that mean, 5 or 10%? Your average bank balance divided by your revenue. So your average bank balance is a function of revenue. 10% is really good. 5% is pretty much where you want to start at. Anything below that's considered quite low, and it could be problematic for getting good terms. And sometimes if it's too low, you won't, like below 2%, you might not get an offer depending on what are the other details of your business may look like. So you have to prepare your business, and you have to make sure that you're setting expectations. Number three, do some research. Go online, go to Smarter Loans. They have a great amount of websites to compare, and check reviews and try to get as much information as you can to be able to decide who you want to apply to. Don't just apply to necessarily the cheapest rate, because you don't know where you fall. You don't know. You might think that your business is prime at 1 or 2 years in business, but it doesn't work like that. There's so many different data points that matter: the industry or in the time in business that you have, how clean your bank statements are, which we just spoke about, and what's on your background. Do you have any past collections, bankruptcies, tax liens, judgments? And some companies will preach that they don't care about personal credit, and they don't. And that's okay. There's products for that as well. But the different metrics that I've just given to you, most companies will use almost all of them. So you just want to apply to a couple that you feel really, really confident about. Get some quotes, get some information, ask a lot of questions. And I think that is some of the best thing you can do, and be open-minded and just collect information. If you go into the transaction with your set expectations of how it's going to be, you may or may not be happy, depending on what it is, because it's new to you and it's a new situation.
Okay, no, this is very helpful for our viewers. And in terms of building on that, what are some things on your end, Jordan, that you've seen, perhaps mistakes that borrowers make, specifically tied to maximizing the potential of different types of financing? Because oftentimes people obtain financing, but they don't utilize that to the maximum potential.
I'm going to share a great secret. If you want to get the best possible deal, be transparent and open. People think that if they share information, it's going to kill their chances. The way an underwriter will work is the biggest risk is the one that you don't know. So if there's a gap and they're not able to figure it out and you're not communicating, they're going to assume the worst. The best thing you can do is say, look, here's my situation. Here's what I'm trying to do. We're looking to find a way to fund the company. And I'm speaking for the industry, I'm sure. We're always looking for a way to fund. We're not in the business of not funding. We're in the business of funding. So do your best to be open and transparent and be in communication. I think some of the things that I see that's the biggest, this probably be the biggest, is the lack of communication. Be open and be in communication. That is what I would say the best thing to do is to maximize. Because if you do, you might be able to get a better offer than what you would have got if you didn't. It happens all the time. They say, okay, let's say we give a 9 or 10-month term or a 12-month term. And they say, hey, blah, 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 blah. And now we understood that. We're able to address the risk, certain risks, and we're able to maybe make an exception that we wouldn't have been able to make otherwise. Oh, the max approval is 100,000, but they only need 50,000. Okay, we'll give another extra month we were never planning to give. Why? Because if they're being financially responsible, taking less, we're like, okay, maybe we'll take some extra risk. So that's kind of an example of being open and transparent and sharing what their objectives are to be able to get maybe what they want. I think that's very important.
Okay, great. And in terms of demand for capital, Jordan, you discussed this before. I mean, you mentioned it before that you're seeing an uptick in demand. I would say the first 2 quarters of COVID, talking to business owners and talking to lenders, demand was drying up. And I've heard from the grapevine that in some industries we're starting to see this rise. But overall, I mean, are you optimistic about 2021?
Yeah, so let's be clear. The Canadian submissions and funding is still way down. There's no question about it. But in the last 6 months, definitely on the rise, and it's coming back. There's no question about that. And am I optimistic about 2021? Well, Ontario does need to get out of lockdown. It does need to happen. I would say that I'm optimistic about right now in 2021, and I'm extremely optimistic about Q3 and Q4 in 2021. I think that will be the time to shine in the latter part of the year. I think as people start to get the vaccine, people start to get back to more normal life. And that, we're in April. So I'd say that, 3-4 months from now, if you just rewind 3 or 4 months ago, we barely didn't have the vaccine yet. So it was like talks about just rolling out. And now 3 months later, give another 3 months, I think you're going to be very surprised about how many more people have now had the vaccine, and now the confidence is starting to build in people. And that's really what it's about. It's all about consumer confidence. And then that increases demand. People then will demand more, and people can get back to a more normal life. And I guess normal means, maybe taking a trip, maybe going outside and not being scared, whatever it is for certain people. But they'll start to do different things that will be more demand, and it'll start to increase economic activity.
Okay. Yeah. And in terms of you, from your perspective, I mean, you've been dealing with SMBs for over a decade now. Greenbox Capital has funded so many businesses. If you had tips or advice to businesses who are looking to perhaps pivot, or people entering the field who want to become entrepreneurs, take advantage of the disruption in the market, what are some things you would impart?
If I wanted to give some advice to business owners who wanted to pivot, I heard that. So to pivot into maybe something different.
Yeah, something
Yes.
different. And also people who are entering, the small business world, who are looking to become entrepreneurs.
When you have a downturn like this, it is the best time to enter. It's unbelievable, because what happens is the strongest are going to survive. But that means that a whole lot of businesses, unfortunately, are not going to make it, right? And that sucks, but it also creates opportunity for other people, right? In any kind of event like this, there's winners and losers. And if basically what I'm getting is, how can an entrepreneur get in there and take advantage of an opportunity? Oh, there's no question that this is the opportunity to start a business. There's no question. If you want to pivot, you have to look. I'm sure most entrepreneurs have that natural spirit of what they feel is missing in the market, right? If they're a restaurateur, like, oh, there's just not enough vegan places. The uptick of veganism is happening, or whatever it may be, or plant-based. I had this great idea. These dishes are great. To start a business, you can start anything. You could start small. And I think COVID taught you can have an Instagram account, and your Instagram account could get out, and you can have essentially delivery happening. And I mean, think about this. You can do it in your own home, set up a Square account, whatever you're going to set up, for taking credit card payments, maybe even Venmo, something so simple. And you're now delivering, and you're now building a business, you're building branding. So this downturn of COVID has been terrible in terms of lives and jobs and all these things, right? But one thing that's been positive is the opportunity that has emerged for even the small guy who maybe doesn't have a lot of money to start a business, can start something right in its own home, and be able to be seen and be heard, as opposed to if you tried that when the economy, let's say a year and a half, 2 years ago, when the economy was doing well, I think that would have been a much more difficult feat. And I think we learned a lot during COVID about what's possible. So my advice, take a chance, start your business, even if it's in your own home, could be through social media, whatever it may be, right? Focus, focus, focus. That is the word I will tell any business owner of what they need to do to be successful. And then if you want to pivot, I guess it's the same thing. If you want to pivot, that's not necessarily a bad idea. Hey, look, we were selling this before. There's no demand for this anymore because the travel industry is washed up. Pivot, absolutely, and keep your expenses down. I think that's one of the things that people learn the most. People probably learned, said, hey, I don't know if we needed all these expenses. Look how much I learned. We're doing the same business, or a little bit less, with way less expenses. I think that's something that's really been a very valuable lesson for business owners as well.
Mm-hmm. Definitely. Well, thank you so much, Jordan. In terms of what's up next for you in Greenbox Capital, is there anything you want to speak to? Any upcoming launches, innovation, news?
Yes. So we have several feature releases in our box. We talk a little about the box. So we created a software platform in 2016, I want to say. We launched it in 2017, which basically facilitates the funding process. And really the focus is seamless, right? Seamless speed in communication. But the communication lies within our staff to communicate effectively. But in terms of the technology, that technology is there to create seamlessness and speed to the transaction. What this does, it basically protects brokers by limiting human interaction in terms of the data that gets provided to us. That's a benefit for the broker. It's also a benefit for the borrower. Speed allows us to process information quickly, to grab the data, process it, provide a credit decision. And then what we have coming up is we're going to release, I can't get too much into detail with it, but there's a few key features that's going to basically be available to the customer, to the borrower, that's going to allow them to get capital on demand without really having to do anything. It really, seamlessness is a key driver. And by the way, as we roll out this technology and as we continue to make it more seamless, we're actually able to offer cheaper cost of capital to the customers because they're consuming less operating expense. We'd like to pass all of that value on to the customer so that we continue to be best in class. So I think that's super important to know that there's a bunch of features coming out for the merchant, for the business owner over the next 4 to 6 months that is really going to put us ahead of anybody on the market. We're very, very excited about that. And then also, on the broker side, I won't go too much into it. It's going to give them the access and tools to be able to customize offers at a whole new level. We already have a great customization tool for them to customize the offer for the customer, which gives them quick on-demand ability. They're now going to have even more tools and transparency so that there's less feedback loop, less time to get that feedback loop from Greenbox Capital to broker because of that extra party in the transaction. We want to set them up as well because at the end of the day, if we don't focus on our brokers, then we're also hurting our merchants because they're dealing with the customers, they're dealing with the business owners. We have to make sure there's a lot of good features for our brokers as well. So in the next 4 to 6 months, I want you to think that there'll be different features rolled out by Greenbox in the software that will be at the fingertips of the borrower business owner when they log into the box. They'll have their own experience. They'll be able to self-serve, help all themselves in about a push of a couple buttons. That's happening in the next 4 to 6 months. And then on the broker side, transparency, ability to give information quickly to the borrower as well.
Okay, and all these tools are going to be available in the Canadian market as well.
Absolutely. When we roll out to all markets. Well, all markets. We are in the United States and in Canada right now. We're actually rolling out in 2022 to another market, but right now it's just US and Canada. So yes, it will be in both markets.
Okay, excellent. Anything else, Jordan, that I didn't touch on that you wanted to expound on or mention?
I guess I would just say thank you to all the Canadians and the Canadian market for being so easy to work with, for being quite intelligent as a population. I mean, really, I can't tell you how often I talk to my people that I meet, Canadians, down here in Miami, or even friends. I tell them how awesome Canadians are. I know I really enjoy Toronto. I enjoy Montreal. I haven't been out west. I really got to get out there, but I really, really enjoy it very much. So no, I just saying thank you. Hopefully, we continue to help the businesses in the Canadian market. That is truly a good feeling. It's a really, really good feeling when you're helping businesses do something great. You feel that result too. Some business doubles their revenue over a year. I'll give you an example. I won't go into detail of this, but there's a franchise. Maybe I can say the franchise, Popeyes. We've watched this guy open like 10 stores. I mean, it's been unbelievable to watch this guy take our capital, open store after store after store, and literally be a part of that. I think that's just been absolutely amazing. It's really, really nice to have that. So it's really thank you for giving us that joy, but also thank you for the opportunity. The Canadian market's been absolutely incredible. I have nothing but great things to say.
Mm-hmm. Yeah, we really appreciate it. I mean, the backbone of both our economies are businesses, right? And I think they've really been hit hard. Industry specific, I think the big box stores have done really well in both our countries, but the local businesses have really suffered the brunt of COVID, right?
Yeah.
And I think all your advice and wisdom will, I think, be very helpful for them. Is there a website that viewers should turn to if they want to learn more about Greenbox Capital and yourself?
Absolutely. Go to greenboxcapital.com. You'll be able to find a lot of information about all of our products on there. There's even information about our staff, not just me, but the entire team. Explore it. There's a lot of great content on there about the business. We even have a blog. It's very unbiased, totally neutral, just about sharing information to educate. Go check that out. Absolutely. Go check that out.
Excellent. Well, thank you so much, Jordan, for your time. It's been a pleasure. It's always lovely talking to people, to Americans. And Florida is basically Canada's second home, right? So many snowbirds travel there, though albeit not as frequently in the past year, but hopefully we'll make our way down there soon.
I hope to see you guys in person very soon. Can't wait till you guys open up your borders. Hopefully soon.
I know. Fingers crossed. All right, Jordan, you take care.
Take care. All right.
Good one. Bye.
Bye.